So, lesson 3 is analyzing how transactions affect owner's equity account. So, last time we analyzed some transactions, but they were dealing with assets and liabilities. So, now we're going to get into owner's equity accounts. So, we're going to analyze those transactions for operating a business into debit and credit parts. So, before we get started, what are the 4 things we have to ask when analyzing a transaction? Remember, there's four questions we have to ask. Remember, Logan? Okay, that's the first thing to ask. What accounts are affected? What 2 accounts? And then what? What do we do with it after that? We have to decide what?
Which side of the account increases or decreases.
Okay, that's one thing you have to ask, but the next thing you have to ask is, Brianna? Yeah, how's it classified? Okay, so we're going to break it down in those 2 accounts, and then we're going to classify the accounts as assets, liabilities, or owner's equity. You have to know where they fall on that accounting equation, whether it be on the left side or the right side. So then after you figure that out, then you can decide which one is increasing or decreasing, and that's going to tell us where to put the money. Okay, so we're going to look at the first transaction here. So remember, we're dealing with owner's equity now. So this one is received cash from sales. Okay, how do we classify sales? Logan? Yeah, it's revenue. Okay, so revenue is an increase in the business. So it increases owner's equity. Okay, so here we have January 10th, received cash from sales, $1,100. So if we look at it on the accounting equation, the 2 accounts affected are cash and sales. One is an asset, one is a owner's equity. Okay, cash increases, so it's on the debit side, and owner's equity increases on the credit side. So cash is debited, sales is credited. Okay, then we have the transaction of sold services on account. So January 12th, sold services on account to Main Street Services, $500. What does on account mean? Josh?
You get it now but pay later.
Okay, you get it now, but you pay for it later. So here, the 2 accounts affected would be accounts receivable, Main Street Services, and sales. One's an asset, one is owner's equity. Okay, so it's going to, accounts receivable is going to increase on the debit side, and owner's equity is increased on the credit side. So accounts receivable is debited and sales is credited. All right, paid cash for an expense. So January 12th, paid cash for communications bill for cell phone and internet service, $80. Okay, so here's that expense. Now, this is where it's different a little bit, because they want the expenses to have their own accounts. They could just put them all into the owner's equity as as owner's equity, but as expenses, but they want to keep them all separate and keep that from being so large. Okay, so here we've got cash and communications expense. One asset, one expense. It's not really a liability, but it decreases owner's equity, but it increases as an expense. So it's showing it as an increase as an expense, but even though it's affecting owner's equity as a decrease. So cash is an asset, communications expense is an expense account that affects owner's equity. Assets are decreased. Owner's equity is decreased. Expenses are increased. So cash is cash is credited. Communications expense is debited. Okay, then the next one, receive cash on account. January 16th, receive cash on account from Main Street Services, $200. So the two accounts we're going to use here are cash and accounts receivable, Main Street Services, two assets. So here the cash is going to increase, accounts receivable will decrease. So debit cash, credit accounts receivable. Paid cash to owner for personal use. So January 16th, Michael Delgado withdrew equity in the form of cash, $350. Okay, so withdrawals are kind of treated the same way expenses are. They want their own account, so everything can be shown in that one account, drawing account. So we're going to use cash and Michael Delgado drawing. Cash is an asset. Michael Delgado drawing is an owner's equity account. Assets are decreased. Owner's equity is decreased. Withdrawals are increased. So cash is credited. Michael Delgado drawing is debited. Okay, so which two accounts are affected when a business pays cash for a cell phone bill? Michael.
Cash and communication expense.
Okay. The cell phone bill would be a communications expense. Which two accounts are affected when a business sells services on account? Colton.
Owner's equity and accounts receivable.
Owner's equity isn't an account. It's classification.
Capital is that.
Nope. What's a sell? Sell services.
Sales and accounts receivable.
Okay, so sales. Sales is affected there. Which two accounts are affected when a business receives cash on account? Logan.
Cash and accounts receivable.
Okay. Cash and accounts receivable. Is the drawing account increased on the debit side or credit side? Colton.
Yeah, increased debit.
It increases on the debit side. Debit, because withdrawals decrease owner's equity. Are revenue accounts increased on the debit side or credit side? Revenue accounts, do you know?
I think it's credit.
Think it's credit? Should be credit because it increases owner's equity. Okay. All right, so let's look at work together. Okay, so in our question assets box, we have account titles and transactions. This is just pretty much doing the same thing we did the other day. This is Jensen Cleaning Services uses the listed accounts. Prepare 2 T accounts for each transaction. On each T account, select the account title of one of the accounts affected by the transaction. Enter the debit or credit amount in each T account to show the transaction's effect. Alright, so first one, March 11th, sold services on account to Johannes Erickson, $125. So if we break that up into accounts, what 2 accounts do we use there? Logan. Okay. Accounts receivable and sales. And then accounts receivable on the debit side, sales on the credit side. All right. March 13th, received cash from sales, $260. Michael, which 2 accounts?
Cash and sales.
Okay. Cash, sales. So we received cash, so cash is on the debit side, $260. And sales is on the credit side. Okay, March 14th, paid cash for telephone bill, $54. Zammy. Okay. So, utilities expense for the telephone bill and cash. So, $54 debit on the utilities expense, credit on cash. Okay, March 16th, received cash on account from Johannes Erickson, $125. Michael.
Accounts receivable and cash. No cash first.
Cash is going to go first. And then accounts receivable. Okay, so we have $125 receiving cash. So debit cash, credit accounts receivable. And the last one, paid cash to owner for withdrawal of equity, $200. Colton. Okay, John Jensen drawing and then cash. So we have the drawing as a debit, $200, and cash credit. Any questions? Pretty simple. Okay, so go to the on your own and then the application problem.